but looks like the first tick on the index is going to be negative. And there you have it, 170 points down, 185 points now, inching towards almost a 200-point cut. The Sensex is down 700 points. Forget about 20,000. It's now inching closer to that 19,700 mark on the Nifty. Straight off the back, Mphasis is down about 9%. But what's more interesting is that it's taken the entire IT pack down with it. So it may not just be an Mphasis specific issue. The fact that Infy is saying that discretionary spends are under pressure may be indicative of the entire sector issue. So HCL Tech, Tech Mahindra, Wipro, LTI, Mindtree, TCS all down about 1 to 5%. HUL is the other one that's dragging down about 2%, so keep an eye out on that. And other losers include some of the winners of the last fortnight or so. So auto stocks, Eicher Motors, Maruti Suzuki, Bajaj, Hero are all under pressure. Reliance is going in soft into its earnings. It's expected to be a muted quarter this time because of weakness in the refining segment. The refining cracks have been under a lot of pressure, so that is reflecting on Reliance stock. On the upside, L&T batting for the bulls up about 2.5%. Titan, that was one of Sanjeev Bhasin's picks as well, up 0.2%. Britannia, FMCG is not doing too badly actually. And some banks are holding up. Kotak Mahindra Bank, IndusInd Bank, Axis Bank, M&M, not too bad. So for the market, yes, we started with a steep cut. Now we're trying to claw back a little bit. In fact, the Bank Nifty is actually in the green, which may be a sight for sore eyes, for the bulls at least. It'll be a good thing, but the opening tick is not bad.
Well, that's right, Sonia. Since IT is dragging, the Nifty Bank will have to play out of its skin today, to hold the Nifty up. The low of the day is 19,776. So if you want a reference point, the 19,750, 19,776, that's the crucial support for the day. In terms of stocks that are pulling back, well, from the broader market, you have Mphasis that's down. Oberoi Realty as well is down close to 3.5%. Mphasis and Persistent, actually, both of them are down in reaction to its numbers. And KPIT Technologies as well has corrected more than 10% from the recent peak. After a big run, Polycab is finally pulling back a little bit. That's down close to around 2.5%. And Havells, the numbers actually were a little bit more disappointing than what was anticipated. So that's pulled back another 2%. Remember, yesterday it came off the high point of the day. On the flip side, IndiaMART reacting to positive results. You also have a buyback that's been announced. Union Bank is up close to around 3.5%, so both of them doing quite well. And a couple of other notable movers with high volumes is Suzlon. Who would have thought it's on its way to become a 20 rupee stock? It's up 5% as we see. Prashant.
Well, there is, 180-point cut on the index, but there is so much going on just below the surface. Polycab is coming up as the number 2 volume-traded stock in the market. It's down 3%. So 20% gain on Polycab after results in the last 3 days. Yesterday, it was limit up at 10%. So that is seeing a little bit of pullback, just a little bit. TCS and HCL Tech, and, I was saying this in the morning, whether Infy will finally sort of, force, or rather force markets to rethink their let's look through this quarter of pain kind of stance, because market so far had looked through all the poor numbers. TCS is down, HCL Tech is down, Tech Mahindra is down. So it's large cap, mind you. And of course, mid caps where there are individual disappointments like Persistent and Mphasis, which are selling off 3% each. So it's a tech day, complete tech day. And we've seen this so many times in the past as well. The entire space goes for a bit of a spin. Havells is down 1.5%, a 13.28 on Havells. It's kind of reacting to the numbers which came out. And what else? Lever, I think we mentioned. KPIT is down about 3 3/4. More tech there for you. South Indian Bank was down 10% yesterday. It's down another 5% this morning. And actually, there is more tech. I could go on LTTS and a few other things. And by the way, right out of the gates, volumes are pretty large. So it's now no dearth of volumes, but it's largely news related. So there is an impulse. Heavily traded, a lot of these tech names. On the upside, Mazgaon Docks, like clockwork, is up another 5%. I think at least the last 2 days, every day 5%, another 5 this morning. L&T we mentioned. RVNL was a big mover yesterday. By the way, RVNL is a top volume traded gainer. It's up 4%, 134 on that stock. IndiaMART is up 3%. The management will be with us. Shriram Finance, it's coming up this morning with volumes, 3% on Shriram Finance, 1830. We've got the dairy companies, right? Dodla, you had Hudson Agro, you had Parag Milk, all which went up 8-9%. I can spot Dodla, which is up 4% this morning. And there is APL, Apollo, and a few others which are coming up with strong gains as well. So there is no dearth of activity. Market breadth is a little negative. We got about 1,000 stocks lower as compared to about 780 stocks, which are higher at this point in time. Ajay Srivastava is with us, CEO of Dimensions Corporate Finance Services. Not a man to mince words, and I hope you don't, Ajay. Good morning. Great to have you with us here. How are things looking, Ajay? Almost at 20,000 and then, well, boom, Infy. So a bit of a setback this morning. But near to medium term, what's your stance?
Well, the stance is very simple. We don't buy at this point of time. Certainly not buying anything in the majorly in the large caps in the market at this point. There are selective stories which are coming around, which are newer themes in the market, which possibly are decent buys. Some good results are coming out. One or two good results came out yesterday, which could become a potential. But by and large, it's like you watch your portfolio is doing well, your shares are doing well. You don't want to commit capital at these rates. I think I am still in the side of the FDI, the PE funds, which in cash at the highs, and they are encashing from the Indian market, then on the side of the FIs who want to buy at this rate. So I'm sorry, party spooker saying better to sell, book your profit, than to buy and worry about how to make a return on stock prices like this. It's just incredible disconnect with the reality. And therefore, one has to be very careful what is doing with the capital. Incredible, absolutely. I think it's, one would say that cannabis is legal in this country, I think.
Oh dear.
It's okay, Ajay. You don't have to be sorry for your view. I mean, there are all kinds of views in the market, right? That's what eventually makes the market, I guess. But there's no stopping this rally. At least that's the sense that you're getting. I mean, what, 15% in 3 months? It's been ferocious, right? What do you do at a time like this when earnings are not that supportive? So if you are, say, invested in names like Mphasis, HCL Tech, TCS, and you see such subpar earnings, what do you do? Do you churn out or do you just book your losses?
See, I think, it's important to focus on the one which are more transient in nature, where you have booked a decent profit. I think these are bellwether stocks. They will see their ups, they will see their downs. And if it's part of your core portfolio, just leave them alone. They will have the bad days and the good days. The problem is that you have to start looking at encashing the weaker parts of your system. I think that's where the portfolio focus is. So one is keep churning out the weaker parts of the portfolio, which don't have a good story. Number two is churn into newer stories. As we have seen, this country has done an amazing thing, newer stories. You have an airport lounge company going on to railways and roadways doing phenomenally well. You got your own fintech companies online, which are doing extremely well. So, we get stories of defense coming out. You saw what happened to the drone story coming out in 2 or 3 companies. So I think the focus of investors should be on capturing the newer stories, then to look at the older stories, because the return on capital employed, that's the key question. You get 9 to 12% today yield in the debt market. Now, how do you beat 12% yield of the debt market instrument by equity? And with a margin of risk, that means you're talking about 18 to 19% threshold rate of return on equity. So you got to be very stock focused and says which of the stocks is going to give you the return of 18, 20%. Themes are not important at this stage. What is important is you are in a new age stock. Are you into new themes, or are you still batting with the old fuddy-duddies, autos, and so on and so forth? Because these are not going to give you 18, 20% returns. I think the mood is newer age, newer stocks, newer themes, and cash them young and early rather than buying at a bigger and higher level and the older stocks. They're not going anywhere. Indian consumer story is not going anywhere this year. So people who think that the great story of retail is about to unfold should be very badly shaken when the results start to come out.
Okay, all right. Actually, just hold on to that thought. As we speak, the Nifty, that buy on dip has worked yet again. We are 100 points off the low point of the day. The Nifty Bank, as we pointed out earlier today, that has to play a stellar innings. And at least for starters, it's got its eye in. It's seeing the ball big and it's smashing it for the time being. It's up close to around 125 points approximately. And though Mphasis is down, that's why the Nifty IT index is down. But you pull up some other stocks. Mphasis has almost moved into the green. It was down close to 4% a short while back. LTI, Mindtree as well has moved up. LTTS as well. So these stocks have recovered at least 2 to 3% from the day's low. Even Coforge now is up close to around 1.5%. Well, Ajay, you were talking about getting into some themes early and identifying them as well. Help us out with some of them. I mean, our viewers would love to know.
No, I just told you, like some of them are very discovered themes. It's nothing new. They look at this airline launch company which started, which is an unknown theme in India, and look at where it has gone. You have seen the defense company, the smaller company, the drone companies, look at where they're gone. For a change, the aviation stock has gone into a different orbit altogether. The competitive scenario has changed. So you are in a safe zone. There's no competition. So the key is look at the sectors which have no competition. If you look at this online fintech space, there are only 2 or 3 companies there. Banks may try to come into the space, very difficult at this point of time. So you got fintech, you got lounge, you got airlines, you got limited amount of hotels. I think they are running out of space at this point of time because homestays will challenge them in the next 3 years. I think hotels have largely done their bit, to my mind. They may not give you that much return. And then, of course, you just mentioned your defense companies, which continue to be a scarcity element in the country at this point of time. So, so put together this basket, pretty decent basket, which comes around to you. And then you have the regular stocks that you, of course, always have in a portfolio, whether it's some metal stocks, whether you got some commodity stocks, which give you very hefty dividend returns. So built up the portfolio looks good. And as you said, market is in an extremely bullish mode. As I said, when you are in the party mood, you really want to keep having one more. The question is, next morning when you wake up, did you really want to have that one more?
Cheers to that.
Well, okay, that's well put. Ajay, ITC, I think we've talked about this in the past, and I know it's been the longest-standing buzz, the demerger of the hotels business, but it's there and it's getting louder once again. Just wanted to ask you, at where it is now trading at ITC, if an announcement of this nature was to come in, is it in the price, or you think it could spur another move higher?
See, okay, for disclosure, we have a holding. So to that extent, we are biased on this one. I think it will spur higher. And I think the reason it will spur higher because it is a start of a process of a thinking. And I think it started with a new CEO 2 years back who started focusing on return on capital employed. So if they split it out, I think what will do, two things will do. One, allow the investor to own the hotel separately and decide to get out of hotel should it want to at some point of time. And number 2 is focus more on the cash generation businesses, like FMCG has become cash positive, the tobacco is positive, and therefore the dividend returns would become absolutely phenomenal of this stock. And you don't have an overhang that tomorrow will just spend 500 crore, new CEO comes on the hotel business. So I think it's more than just the demerger financials. It's a statement of intent that we're going to keep a cash flow engine of the FMCG company running without any serious capital commitment. That's a big significant shift. We'll see a major bump in the market if it happens, if they do a pure demerger. That's a wonderful thing for the market. You saw what happened in Reliance, an ordinary company which had no track record came out and the market had a blip. Now, whether the blip sustains, we don't think so, but whether it, for the time being it did. I think ITC, on the other hand, is a much more powerful thing because you have a split of a good quality operating asset which can have a miles to go and miles to run in a it's like an aviation. It's a 2-leg race in the market for hotels. Just 2 groups or maybe third lemon tree in the middle of it. But I think it's a 2-sting, like airline.
Sure.
Love these 2 duopolies who both want to make money. Unlike the telecom, where one guy decided he doesn't want to make money and the whole sector went for a toss.
Okay, by the way, don't lose sight of what's happening in the market. So the Nifty has recovered almost 100 points from the day's lows, and this is courtesy the banks. The banks are really batting for the bulls hard. So bank Nifty is up almost 130 odd points. So keep that on your radar. Definitely some buying coming back. But Ajay, another space I wanted to ask you about was this whole home improvement theme, right? Because not just Polycab, which was definitely the stock of the week, very good numbers there, but even others in that space, whether it's Havels, whether it's Finolex Industries, margin improvement has been steady, and so many more coming up now in the next couple of weeks. Do you think this is a space to latch on to despite the expensive valuations?
Sorry, just to come back to the market, I think if you look at what my desk is telling me is the story lies in the futures of Nifty. While the Nifty was down almost 0.9% or 1% in the morning, the futures were only down 0.3% at the worst part of the day. So I think the story is unfolding on the future side more even than the cash side as to where the buoyancy and the confidence is coming. And so I think the pointer, just for the investor's sake, should be just keep looking at the futures more than the cash, because that gives you the pointer where the mood of the market is at this point of time. Coming aside to the home improvement theme, I think the theme is doing well. The real estate boom has just started in the sense of the kind of construction and the projects launch. They will see a good trajectory. Having said that, I think someone like Polycab, they got a big benefit of exports. It was not really, if I'm not wrong, my research report says it's more export that gave them the benefit than domestic. But I think the story is steady, except the fact, and I think this is an important part, except the fact I don't think these stocks will give you a healthy return. They've factored in a lot of growth in them, and a slight wobble on the real estate also side could take them apart. So I think they are overpriced, if you ask me. Whether any other stocks, certainly overpriced. To get a return on this means that they need to perform at 140, 150% of the projections. Market mood can do whatever it does, but for them to perform and give you a 20% return in the next 3 years, they need to do a really heavy lifting. I'm not sure. And real estate developers, mind you, Sonia, extract a very steep bargain when they buy from these companies, the product in bulk. And, and that is where the bulk of the market is going to come from, the real estate developers. So my guess is you will see, and you saw in the results, margins are still squeezed, even though volumes are up. So as a sector, would it outperform the market? Answer is no. Would I buy them? Answer is no. Will it seem too expensive? Absolutely too expensive for the growth that is going to come to them.
Okay, well, Ajay, we would have loved to continue this discussion, but we have many companies that are lined up and, some of them in the IT space, which is, of course, top of mind. So we're going to take your leave now. Thanks a lot for joining us and have a great weekend. Okay, that's Dimensions Corp. By the way, the stock on our radar right now is Coforge. And it's interesting because at a time when Mphasis has actually cut their guidance, Coforge has maintained their FY24 revenue guidance of 13 to 16%. So at a time when all IT stocks are under pressure, Coforge is actually up almost 0.5%. But the margins contracted by almost 400 basis points sequentially, but a big jump was seen in order inflow, which is up 76% sequentially and 69% year on year. And as I said, the most important part is the company has maintained their guidance. Sudhir Singh, the CEO and Executive Director of Coforge, joins us now to talk about that. Mr. Singh, good morning and thanks for joining in. I wanted your view on what's happening in the industry after Infy's numbers. So Infy saying that, discretionary spends are lower, timelines are getting delayed for the start of deals. Is this an Mphasis specific issue, or do you think that this is something that the entire industry is facing? And in that context, would it be tough, you think, for you to maintain your full year guidance?
Well, let me take the questions in reverse order. We feel absolutely confident, and I mean this emphatically, absolutely confident that the guidance that we've given is rock solid. We don't see it, and we've stress tested it multiple ways. We just don't see any scenario in which we're going to miss our guidance. 13 to 16% constant currency growth this year is something we will deliver come what may, and our confidence has only gone up after our performance in quarter one. 2.7% sequential growth in quarter one came on the back of 4.7% sequential growth in the previous quarter and 3.7% in the quarter before that. So given where we stand today, year on year, we're growing almost 18.5% in CC terms, quarter one over last year, quarter one. We feel rock solid about the guidance that we've given. That we will deliver on come what may. As far as the macros in the industry are concerned, I guess there's no denying the fact that the macros are uncertain. Demand is depressed. So that's the macro scenario. Specific to us, we think we've proven to ourselves, even in this quarter, even in a vertical like banking financial services that is significantly stressed, that not only can we grow, but we can sign large deals, and we have signed a $300 million TCV 5-year large deal in BFS itself. So that's how I would posit it. Macros continue to be uncertain, but do we feel confident that we will deliver the growth that we've talked about? The answer is an absolute, emphatic, clear yes.
When we speak with investors on IT, the only thing they talk about is this large looming uncertainty on the macros. And we'll come back to numbers in just a bit. But just to press on that point a little longer, sir, take Infosys' case, right? They made investors, I think on the 29th of June, 28th of June, I think, the reported numbers on the 19th of July. They were sounding absolutely confident back then. Nobody changed their numbers, estimates, etc. And then, of course, we saw what happened yesterday. Of course, it could be company specific. It could be a client, two clients. Is that a risk that you see? Something similar? You're sounding very confident that you will do what you promised. But just to take on that point.
Well, let me put it another way. We've delivered on everything that we promised over the last 6 years. The guidance that we've given every year is a guidance number that we met without fail. As we speak right now, the view that I have, the view that the firm has, is a grounds-up view. We're not just looking top-down from a macro perspective. We're not just looking at the fact that we are already 18.5% CCYOY higher than where we were at the same time last year. Looking at the orders that we've already signed up for the next 12 months, which is what we call an order executable, that's already at $897 million. That's 19.1% higher than the same metric order executable 12 months back. So our confidence doesn't come, and of course I can't comment on Mphasis and the circumstances therein, but our confidence comes from a grounds up build, from conversations we've had with clients, from contracts that are signed up, and from the fact that every time there's been a consolidation opportunity within our client set, we won. So in our case, large deal velocity is unimpaired. Last quarter proves it. The previous quarter proves it. Q3 last year, we actually had 5. So that large deal velocity is unimpaired. Large clients, top 10 clients continue to drive growth. We continue to be on the right side, like clockwork, of any consolidation that's happened. Hence, the confidence comes from a grounds up build. 13 to 16%, as I said, is something we feel absolutely confident about. And this isn't just us making an assertion. We have a 6-year record. If you look at the order executable number that we declare every quarter, and you tally that with the actual revenue that Coforge has realized in the subsequent 12 months, you will find a very strong correspondence. So this isn't just a forward-looking statement with no basis in history. 6 years, 24 quarters, our record bears the fact that we deliver on the estimates that we provide, and we feel extremely confident, and I guess I've said that a couple of times already on the call.
Well, you're saying it as it is, Sudhir, and I can feel that confidence in your tone as well. So let's talk about a couple of other aspects then. You're in that journey to move from $1 billion revenues to $2 billion odd. And, there is some kind of expectation that there will be some M&A activity. Could you tell us when you're going to move on that front, point number one? And also currently the promoter entity is the PE, Bearings. And they have brought down stake from around 50% to around 26% odd. Now you're leading the firm. Have you heard anything from them?
Let me just address the first question, which is the M&A activity. I want you to know that we are very keen, incredibly keen to make sure that we do acquire in areas of interest that we publicly called out. So anything around data, anything around cloud, anything around low code, no code, or a new sector like healthcare would be of great interest to us, is of great interest to us, and we have active conversations going on. Nothing that I suspect is going to close very, very soon, but we are clearly extremely interested in using acquisitions as a strong prong for getting from $1 billion to $2 billion with great speed. That's the broad intent. Really no comments on the promoter stakes. BPA has been, they've been fantastic supporters, fantastic advisors over the last 4 to 5 years. The management team continues to focus on performance. We've created our next 5-year roadmap, and we feel very, very strongly that the next 5 years will continue to be very strong growth years.
So, I want to ask you about what's happening in the BFSI space, because earlier you had mentioned that there is some caution over there. 30% of your business comes from BFSI, and your larger peers like Mphasis have also talked about how there is a slowdown there. What kind of growth rate are you seeing in the BFSI space for your own business, and will it be slower than what we've seen in the preceding years?
It's likely to be slower than the kind of growth that Coforge has charted out, but the growth that we've charted out, if you look at us, has been, I would call it abnormal compared to industry growth rates. Last year, our BFSI business grew 45% over the previous year. There's been a 7-quarter stretch where the Coforge BFS business has grown double digits sequentially for 7 straight quarters. From that growth rate, we expect it to moderate. This year, we called it out earlier, we would expect our BFS business to moderate and get back to the company growth rate of about 13 to 16% in the current year. This quarter, BFS grew 3.3%. The previous quarter, it grew 5+%. For the year, we expect the BFS business to be somewhere around the 13 to 16% CCYOY growth, FY24 over 23.
So this 13 to 16% compares to what on an average in the preceding years? I didn't get that.
Last year, BFS grew 45% for us, and it was the clear outlier. This year, the travel vertical has picked up significantly. Insurance has picked up significantly. BFS has moderated. Overall, the firm, therefore, as a consequence, will deliver the 13 to 16% that we talked about.
Okay. All right, we'll leave it at that. Thanks a lot for joining us and speaking about the business and more importantly, the industry and what's going on there. Let's slip into a quick break. On the other side, another big mover this morning is IndiaMART. Dinesh Agarwal of the company will be joining in to talk about their Q1 earnings. We will also have the management of Mphasis for their Q1 results coming up in just a bit. Stay tuned.
Welcome back. Well, just a few stocks that are doing well this morning because the Nifty actually was giving signs it's going to recover back towards that 19,900 odd mark, but that got sold into. So the intraday chart should come up for you. We're back down towards that 19,800 mark. Well, let's focus on a couple of good numbers, as I said. IndiaMART, well, they reported a good set of earnings in the first quarter. Their margins expanded by around 280 basis points, while the revenue as well jumped by close to around 25%. Although the company did witness a dip in the paying subscriber additions. Mr. Dinesh Agarwal, the founder and CEO of the company, joins us on the show. Hi, Mr. Agarwal. Good to have you on the show. And, you're an outlier today because the markets are in the red and the stock, in fact, is trading well in the green. So clearly the street likes what you've announced in terms of your numbers. Give us some outlook from here on. Your margins have improved. By when do you get back to around that 30% odd in terms of margins by the end of this year? And also your subscriber addition, that's come in a little bit lower. I was going through your website and actually you've increased the pricing. Has that hurt this addition? Is that one of the reasons?
Thank you, Nigel. I think in terms of the margin question, I have been answering this, that we will try to see how from here on we can reach back to around 30%, maybe by the end of this year or so. And this quarter-on-quarter fluctuation is because of our business nature of business accounting, because the collections come in upfront, the revenues flows from back, while the cost also gets upfront. So in every Q4 there is a higher cost, and that is why you see this margin fluctuation. But on an overall level, if you see year on year, I think we are better off than pre-COVID levels, and I think we will slowly try to improve from here. On the customers front, yes, we have taken a price increase. We were before COVID, we were at 3,000 rupees a month, and during the COVID, we gave this support to 2,500 rupees a month, and we have again gone back to 3,000 rupees a month, and that has hurt the paying subscriber addition by about 2,000 for sure. We also had Q1 is generally slightly weaker. We also feel that there is some amount of churn which has increased, probably due to Q1 or probably due to base effect, because last year we have added a very good number of customers. So I think that is also showing up.
Okay, all right. So Mr. Agarwal, you're saying that this price increase that you have taken, that will hold out. But do you expect then the addition to go back towards that 6,000 to 8,000 that you have been doing?
Yeah, I think maybe just one quarter or so. I think we should look at 6,000, and then we will again try to go back to 7,000 to 8,000.
Okay, so you'll go back to 7,000 to 8,000. So 1 quarter of pain and then perhaps 7,000 to 8,000 on an average is what you'll see in terms of paying subscribers, right?
Yes.
Okay. Let's talk a little bit about what the average revenue per user was. In this quarter, what did you see as the ARPUs? And also, I think on an annual basis, you were looking at an increase of around 5 to 6% in your average revenue per user. Are you on track to do that, or do you think that could be a struggle?
Yeah, we are on track to do that. In fact, we are doing better. If you see, annualized ARPU in the last 2 quarters have grown by 7% and 8%. Y on Y. Even sequentially, they have grown by 2%. So I think we are on track to do that 5 to 6% ARPU gain.
Okay, so 5 to 6% you're on track to do that. The collections have gone down on a quarter-on-quarter basis if you look at it in Q1. I think it's a 23% dip that you're seeing quarter-on-quarter. Can you explain the reason for that, and what would the collections look like on an average in the quarters to come?
No, so quarter four, as I said, is a seasonally very high quarter.
Okay.
You know, if you see year on year, the collections have grown by 25% or so, and quarter four cannot be compared with quarter one. Quarter one is seasonally low, and quarter four is seasonally very, very high.
All right, Mr. Agarwal, good to see. We have been chatting for last many quarters, and I keep probing you what you're going to do with your cash. Now, you announced that buyback. It's a small one, but if you want to send out a better signal, maybe the promoter entity should not have participated. I think you're participating, right, in it?
Yes, it is a tender offer, and everybody is participating.
But it would have been, I mean, from the investor community, it would be more heartening to see maybe the promoter entity not participate, but we take it that you're going to be participating in it. Any more M&A activity that we're looking at, since still you'll be sitting on a good amount of cash?
Yeah, so I think, three different possible uses of cash. One, obviously, for internal accrual purposes, internal safety purposes. Second is we continue to look for M&A opportunities. And if we find anything useful, we will definitely look at that. And third is returning cash to the shareholders, which we are trying to balance every year.
So M&A, you haven't identified anything for this calendar year yet?
Not yet. We have been trying to find something, but we haven't found anything.
Okay, got that. Would you like to end by telling us what you can guide for in FY24? Because in FY23, your performance was very good, a 30% growth on the top line. Is this something that you can replicate in FY24?
FY23 had a base effect of FY22 also, because the quarter one of FY22 was a little washout to second wave of the COVID. So I don't think we would see the 30% growth, but I think we will try it and maintain the growth that we have been able to do, about 24-25% this quarter. We'll try and maintain that.
You made one acquisition, right? The Busy Infotech, I think so. Out there, I think margins have been a little bit lower because of higher employee cost. How do you see things shape up out there? Give us a broader guidance from there. How do you see this acquired entity ramping up from here on?
We are very happy with the Busy acquisition, the way it has turned out. I think my objective at the Busy is to grow the revenues and grow the subscriber base, make the software more cloud-based, cloud-friendly and mobile-friendly, move slowly from the one-time licensing fee to a subscription kind of a model. I think the first year has not come with any surprises. And we don't worry about margins there. I think we are investing behind the growth. The good part is that it is not consuming any cash and continues to grow healthy. This year, we should see even better growth coming from Busy.
Okay, I think the street is also quite convinced of that. It's up. The stock is up almost 7.5%, so they definitely like what you're saying. Thanks a lot for joining in. Appreciate your thoughts here on CNBC-TV18. By the way, just a couple of outliers since we're talking about IndiaMART, which is up 7%. We have many other stocks. Union Bank is up almost about 3% We'll talk more about that with the management later on the show, so do stay tuned in for that. And a couple of other names, keep an eye out on PVR. Big releases coming up later this weekend, so of course all eyes will be on that. And something like a Phoenix Mills coming back as well, ABB India, Macrotech Developers. So even in a falling market, there are some pockets that are standing out.
Oh yeah, I mean there are. It's not one way at all, and we've had a one-way market, but up. So it's not. 1,100 stocks are higher, 860 stocks are lower. I mean, yeah, so more declines than advances, but what's going up is going up on pretty strong volume. So just to add to that list, I mean, IndiaMART, of course, we just mentioned. Look at Tanla Solutions, Suzlon. I mentioned Shriram Finance, which has not been in, in the mix over the last many weeks, but now this morning it's up about 4% or so. IRFC, Newgen, I mean, big gains after the results recently. So it's up 3% this morning as well. Sterling and Wilson Solar is up quite strongly. Sanjeev Bhasin was talking about Piramal Pharma. That one is up about 3%. It's back at about 103. Talbros Auto, I mean, it's a smaller auto ancillary name, but it's coming up with volumes and it's done phenomenally well, by the way.
Because, Prashant, they announced that they're going to be considering a stock split on August 8th. So that was the reason
I see,
think
more
that
liquidity,
stock,
I guess. So 828, I mean, this year the stock is up 45%. So it's just quite incredible what we have seen. Stock used to be, it closed 2021 at with I think 400 rupees, and it's at about 828 odd rupees now, so in a year and a half or so. I think we've got the management of Mphasis now joining us, and we can go across to them. They've reported a revenue decline for the third consecutive quarter. The decline was expected, but what they've reported is perhaps a little bit more of a drop as compared to what markets were expecting. Manish Dugar is Chief Financial Officer of the company, and he's joining us right now to take some questions. Manish, good morning. Good to have you with us here. Thanks very much. I'll get to margins in a bit, but let's just address that 3.5% quarter-on-quarter constant currency revenue decline. What caused it? I think both in the BFSI vertical and the logistics vertical, things have been a little weakish. What are you seeing in the marketplace?
This was not unexpected. Combination of the volatility in the banking space and the mortgage business because of what's happening in the interest rate were kind of anticipated. I think the more important thing for us is the strong deal wins that we had, $700 million of contract closures. Over the last few quarters, we had seen that origination was kind of going strong, resulting in pipeline growing. Conversion of that into contracts and then conversion of contracts into revenues is where the delay was. The good news is at least the contracting has started picking up. $700 million was the record quarter for us. And we have also started seeing those contracts starting to deliver revenue in quarter as well. So as we go forward, as the backlog that we have built over the last few quarters and the contract closures that we have had now starts converting to revenue, we feel confident that that should give us strong sequential growth in the coming quarters in the rest of the year.
Got it. Nitin Rakesh is also joining us, Managing Director and CEO of the company. Nitin, good morning. Great speaking with you here on CNBC-TV18. We don't get to chat that often, so good to see you. Just a quick word, Nitin, just to take off from what Manish said. Will we see improvement progressively from the second quarter onwards for the rest of the year? And how much of that is predicated on what's happening out there in the US? Especially, say, for example, on the mortgage side of things. Talk us through that.
Thanks, Nigel. Thanks for having me. Great to talk to you. And I think, as Manish was mentioning, we've seen some green shoots in at least the opening up of the decision cycle as it comes to awarding those deals. And then, of course, we've seen some early signs where conversion to revenue is also starting to at least get visible. It's nowhere near where it needs, where it needs to be from a normalcy standpoint. Specifically, I think the reason why we have called out for a base formation or a bottoming out in Q1 is linked to the fact that we've definitely seen some uptick in volumes on the mortgage side in some segments, especially home equity lines, diligence services, and increasingly in the due diligence space, as well as the capacity creation requests from customers as they expect these loans to start getting restructured. That definitely has, at least in our view, for now, put a line under the leakage that we had from the mortgage side of the business. I think the nature of the pipeline and the deal wins has also been fairly broad-based, so that gives us visibility into growth outside of top 10 and BFS, and that's the reason why we do believe that some early green shoots are visible. We do believe that growth will accelerate sequentially through the remainder of the year.
Okay, so early green shoots are visible and growth will accelerate for the remainder of the year. Nitin, hi, this is Sonia here. Thanks for joining us on the show. I have a couple of more questions on the BFSI segment, which has been hit this time. But before that, I wanted your thoughts on what happened with Mphasis. Not so much because they speak about a slowdown in discretionary demand, but also they're talking about how deals are getting delayed. Is that very company specific, you think, or is this something that the entire industry is facing? And if yes, what would the read-through be for a company like Mphasis?
So, Sonia, I think again, I'm not qualified to comment on what's going on in another business, but all I can tell you is we did call out the fact that if you look at the three stages of the life cycle of a deal, origination actually has been fairly robust. We have been adding new deals to the pipeline pretty much through the last 4 quarters, and hence every quarter the pipeline growth was sequentially higher. However, the TCV wins for us were fairly flattish in the 325 to 350 range. What we've definitely seen an uptick in is the pace of closing of those deals. Some of them were obviously in the pipe. Some of them were added recently. A third of the deals were also AI-led, which basically means that that's definitely something that clients are very keen to continue to implement and expand on. So I think green shoots basically are visible around BFSI. There are segments of banking where demand is actually a lot better. Consumer, wealth and asset. I think mortgage, as I mentioned, is starting to see some turnaround. But there are segments of banking where the demand just isn't, back to normal or won't be for a while because that's very dependent on the cyclicality of either the capital markets or the interest rate environment. So I think it's very nuanced, very specific to the domains you're operating in, very specific to the geographies you're operating in as well. We've seen good traction in Canada in the last quarter. That has added a 40 million plus deal for us, which is a big win for us in that region because we've been investing for the last 18 months in the region. We've seen good pickup in pipeline in Europe, but conversion is actually fairly slow. So I think it's definitely an industry-wide issue where you have seen slowness in decision-making and extreme tightness in existing spends and discretionary spends. So I think the scrutiny on discretionary spends or short-term spends has been really, really high. So I think that's definitely an industry-wide phenomenon.
Okay, that's an important takeaway for us, that it's not just Mphasis related, but this slowdown in discretionary spends perhaps is an industry-wide phenomenon. Got that. Nitin, one more question, since you mentioned a lot about deals. The average large deal size in FY23 on the whole was around $60 million for your company, and that has doubled from where it stood about 3 years back. Just wanted to understand, where does it stand at in Q1 and what could it be for the rest of the year, the average deal size?
So I think, Sonia, there are 2 or 3 things that go into the size of a deal. Firstly, what is the service line? So we've done multi-tower deals. So we are not only doing run, but we're bundling run and change. In many cases, there's ops transformation, or there is tech transformation, replatforming, cloud migration, or transformation included in there. So the nature of deals has become multi-tower, and definitely compared to 5 years ago or 3 years ago, the duration has definitely picked up for us because many of these deals require a 3 or 4 year transformation journey or a roadmap. But in the recent past, I think in the last 12 months, the durations held pretty steady, but just the number of deals has ticked up. This quarter, we had 4 deals over 100 million each, and that's definitely adding to the average deal size, so to speak. So I think very pleased with the fact that we are able to originate and close large deals, and they are actually across verticals, across client categories. We called out for the fact that significant proportion of the deals came from non-banking as well as non-top 10 customers. Of course, we did 2 large deals in banking as well this quarter, which is very, very heartening because that segment is really something that we are very extremely, of course, exposed to, but also looking for signs of a little bit more normalcy there. So I think very pleased with that performance. Very, very, looking forward to continuing to convert the pipeline that is also up at this point.
Nitin, this is Prashant here. And this is an unfair question, but I'm going to ask it. So up to you if you want to answer it. In another lifetime, you were also on the capital market side, a lifetime ago actually. So I'm going to ask you to don that hat to tell us. I mean, for investors who are watching, with all that is going on in the US, uncertainty, there is of course, throw in this AI mix as well, which gets talked about quite a bit nowadays. Is Indian IT a structural kind of story? From where one will make money even from here?
I think you will definitely, again, I can't commit that I'll give you an unbiased answer because I'm invested in the sector and the segment. But having said that, this is not the first time we are seeing cyclical slowdown. This is not the first time we are seeing a tech pivot. We've seen that at least a couple of times just in the last 10 years, and we saw a pretty significant pivot starting 2000. So I think I have, of course, I'm part of the industry. I am very, very confident in the ability of our companies in the sector to continue to adopt and embrace tech and really stay meaningful to end customers. We have seen definitely massive investment being done by almost every large player, whether it was in the digital era, clouds, centric investments, and now, of course, AI-centric investments. And not to forget, we are also probably best placed on the planet as an industry to actually continue to give efficiency on both cost and productivity to our customers as well. So I think to me, this is a secular tailwind. We are definitely in a structural tech investing super cycle that will last not just 1 or 2 years, but potentially, as we call it, a decade for us to continue to play in.
Okay, that should be that's very confident sounding, and I think useful for investors to hear it from you. Thank you very much, both of you, for joining us, Nitin and Manish. Appreciate your time here on CNBC TV18, and hope to speak with you more regularly as well, Nitin. Well, 114 points lower on the Nifty, and I think the reason why the market's coming back once again is Mphasis. Look at Mphasis; it was down 9%. And is down about 6% now. So there is a little bit of a bounce which is coming through. Utkarsh SFB is on your screen, and look at the listing which is coming through as compared to the issue price of 25. That's making its debut at 40 rupees per share. So that's a big one coming through. The management, some exchange officials up on the screen ringing the bell and bringing another company into the market. The IPO market, of course, has been super strong, for a while now. Mphasis is what I was talking about. If you can have that up briefly. You'll be able to see and understand why the index, the Nifty, is recovering as well. 7%, it's down from 9, it's down about 7 now.
Also, the Utkarsh listing is not bad. I mean, given that today has been a weak day, right? I mean, the listing is not bad at all. It's listed at a premium of 60% compared to the issue price. And the company, has been growing its customer base. It's been present in the MFI sector for a very long time. It's been growing its customer base very well. And a lot of the internals of Utkarsh SFB have been improving, whether it's cost of funds, whether it's, the CASA deposit ratio, etc. All of that has been improving quite a bit. And that's reflective in the stock as well. Let's do one thing. Let's get Mitesh Thakkar back on board to tell us how to approach the markets now. Mitesh, still down about 120 points. What's the technical view, and what about individual stocks? What are we looking at?
Yeah. See, in the morning I spoke about the fact that closer to about 19,740, 50 explore long positions, we actually didn't get that level. About 25 points higher from there is the low. But I think this market, at least with this gap down, also hasn't disturbed the trend, I think, unless until we see a breakdown 19,700. So I think that view remains that broadly, after hitting or getting very close to 20,000 levels, some profit booking has happened, coupled with the fact that Mphasis was a negative news flow which affected the index as well. But in case we don't break 19,700, then I think next few days could be spent within this range of 19,700 to about 19,980, 20,000 levels, about a 300 point kind of a range. And that consolidation should help us get past 20,000. So I'll watch this level very closely. Still attempt longs closer to about 19,750, 740 with a 50-point stop loss. And that's the index view broadly.
All right. And on individual stocks?
Yeah. So on the stock side, I think, National Aluminum and disclaimer we have recommended to our clients. We have some questions as well. That is a buy with a stop below 90 for targets of around 98 on the upside. And the other stock which I like is Cipla, which is showing good continuation. So why here with the stop at about 1,040 for targets of 1,085.
Mitesh, thank you. Keep an eye on United Spirits as well. It's at the high point of the day. It's a big recovery from the day's low. USL numbers were strong, but I guess the market was a little iffy. The EBITDA is some 30-35% above estimates. And I think that's making a comeback, 995 as I said. We'll take a quick break here. Quarter se quarter tak, our segment to focus on sectors as they report earnings. And we're focusing on the steel sector and expectations from the first quarter. Nigel will walk us through the expectations. And Amit Dikshit of ICICI Securities will be with us to talk to us about what he will make of the numbers. Stay with us.
All right, here's our special offering, Quarter Se Quarter Tak. Nigel will join in to tell us about what he's expecting from the steel sector. He's walked over to the big wall. Nigel, over to you.
Well, in the upcoming steel results, there are three key factors to focus on. One is strong volumes, lower steel prices, as well as higher coking coal costs. Let's elaborate on each of them in a little greater detail. Shipments of major ferrous players are expected to increase year on year, driven by growing steel consumption. Tata Steel India, well, the dispatches are 18% higher on a year-on-year basis, led by domestic deliveries, while exports remained a little bit subdued. Now, JSW Steel's India operation production also jumped by close to 10% on a year-on-year basis. Realizations, though, will limit the top-line growth, as prices will be lower by around 1,500 to around 2,000 rupees per ton, sequentially that is, and around 15% lower on a year-on-year basis. This is due to the sharp rise in steel exports coming out of China and the weak global steel demand as well. That's what's put some pressure on global steel prices and reflected on domestic prices as well. Now, coking coal prices, they have corrected sharply, but costs could increase by around $5 to around $20 per ton, depending on the kind of inventory that the steelmaker is carrying. Running you through a quick snapshot of the expected EBITDA per ton by ICICI Securities, Tata Steel India EBITDA will come in lower by more than 40% on a year-on-year basis, while its European operations will continue to report a negative number on the EBITDA per ton basis. As the volumes were lower over there in the European business, that's because of the shutdown in the past quarter. JSW Steel, well, the EBITDA per ton could correct by around 27% on a quarter-to-quarter basis, while sale EBITDA per ton could come in lower by around 50%, both sequentially as well as on a year-to-year basis. They've also given the key stocks to track for their upcoming results season. From the metal space, well, on JSPL, they expect the best performance among major steel players, with the reported EBITDA per ton likely to remain flattish sequentially compared to a decline for the other players. For JSL Stainless, they're expecting the EBITDA per ton in excess of 20,000 rupees. And for NALCO, they expect the company to perform better than Hindalco, mainly due to the captive mining at the Utkal D coal block. Going ahead, the street is tilting towards ferrous in comparison to non-ferrous, as ferrous players could benefit from the improving spot spreads and also stronger traction in the domestic market. While on non-ferrous, well, the stocks could be under pressure due to market surplus in key commodities caused by subdued global demand. The key factors to track from here on, though, include domestic demand, management commentary on spreads, and let's wind this down then with a quick snapshot on the valuation parameter of the key ferrous players as well. But let's get in Amit Dixit then. I think he'll join us in just a bit. So, Sonia, back to you.
All right. Thanks a lot for that. So that's what you can expect from the steel companies. As Nigel pointed out, we'll just touch base with Amit Dixit in a bit. But the stock of the moment is actually the new listing. In case you missed out on it, Utkarsh Small Finance Bank is having a rocking time. It's not a small move, 60% higher almost in volumes, picking up on that one. So day one is turning out to be pretty strong for Utkarsh Small Finance Bank. Apart from that, you have Piramal Pharma. Remember, Sanjeev Bhasin was also talking about that. Piramal Pharma up almost about 4%. But let's try and connect with Amit Dixit, the analyst at ICICI Securities, to tell us what he's expecting from the metal sector. Amit, thanks a lot for joining in. You just heard, Nigel put out the key expectations. But you tell us, from the universe that you cover, could there be any positive surprises this time around? Where do you see caution as well?
Yeah. Good morning, Sonia. So this particular quarter is a very atypical quarter, I would say. Previously, we have been accustomed to seeing steel companies reporting a very, very, similar, I would say, decline in realization or increase in costs. However, this quarter is a little different because based on the inventory that companies are carrying, you would see a differentiated performance. So to that extent, for instance, in steel, EBITDA per ton, we expect it would be down QOQ to the extent of 3,000 rupees on an average. However, JSPL would be an exception, where EBITDA per ton is likely to remain flat, adjusting for the inventory revaluation that they did in last quarter. So that is mainly because of the thermal coal cost that is lower for them, and that doesn't apply to other steel companies. Second point, as far as the realization goes, we expect Tata Steel to actually report a little bit of an increase in realization, that is around to the extent of 500 rupees a ton, mainly because of the contracts. So, and in iron ore, similarly, we expect JSPL, for instance, to report lower iron ore cost compared to last quarter, while some other companies such as JSW Steel are likely to report higher. Now, having said that, if you look at the from the pack, we believe that there are certain companies that would still show a differentiated performance. The one, Jindal Stainless. So we will see that the record EBITDA that the company did in the last quarter, there would be only a slight dip QOQ, mainly led by steady realizations, and EBITDA per ton would be around 20,000 rupees, in excess of 20,000 rupees, I would say. Nalco, another stock to watch out for, where the start of captive mining would help them in controlling costs despite lower aluminium prices. So these are the two stocks that we would see performing well. Apart from that, Shyam Metallics, of course, because of the capacities that have come on board. So because of higher capacities, the volume would be up, and that would offset some of the decline that you would see in realization. Notwithstanding that, the company would also get advantage of lower thermal coal cost.
Okay, hi Amit. Good morning. Thanks so much for joining in. Amit, JSW Steel, after many quarters or many years, we're going to be getting the numbers at around noon today. They're in Tokyo, so that's why the management will be declaring the numbers out then. We have the expectations, but I just want to ask you, there were some reports a few days ago that suggested they're looking at that Canadian coal mine, which will help them in backward integration, but the valuation looked very large. How would you approach it if they're going to be raising $2 billion, to buy that 20% stake or thereabouts? Won't it further put pressure on their balance sheet?
Yeah, so we would get clarity on the con call regarding that particular potential transaction. At this point in time, I would say that the valuations that are being rounds are steep. But the company wants to get hold of captive coking coal. The reason being that coking coal prices have been very volatile in the past. That said, balance sheet already on leverage, they are probably the highest on the street. However, we would like to hear more on the con call regarding the thought process behind this transaction and the value that they see actually getting unlocked.
And the report was indicating that earlier, the valuation that was being discussed is $22 billion. So that is going to be a very large number. Even if they have to buy 20%, it'll come to around $3 to $4 billion. That will be too huge, right? What number will disappoint you actually? Either in terms of the quantum that they are buying or the total money they're putting on the table?
No. So currently, well, we don't have a great deal of details on the reserves, on the kind of plan that they have. So potentially, even $3 to $4 billion dollars would look cheap in context of the reserves that they have in store. However, on the face of it, I do agree that this seems to be a steep valuation, but we would like to get more on the drivers of this transaction from them in the con call today.
All right, Amit, we leave it at that. Thanks a lot for joining in and pleasure speaking with you. That's what you can expect this quarter in the steel sector. But let's get back to the markets now. There's no real recovery. The market is still under pressure, down about 150 odd points. And Mphasis is still down about 7.5%. The other spaces that are under pressure are the leaders of the last rally. So whether it's something like a Polycab down almost about 5 odd %, Ramco Cements, Persistent Systems, PB Fintech also pretty weak over there. But it's been a solid set of Q1 earnings from Union Bank of India. Lata is joining in for that. Lata, over to you.
Thanks a lot for that, Sonia. Yes, solid is a good description of the Union Bank numbers. The return ratios are solid. 1% ROA we haven't seen in a while. Asset quality has improved. Net interest margin expanded. I haven't seen that kind of a 3.3 number in a long while. Mrs. A. Manimeghalai, the Managing Director and CEO of Union Bank, joins us. Ma'am, good morning and thank you very much indeed for joining us. I think one of the more impressive numbers is the deposit growth year on year and quarter on quarter. To what do you attribute this? I mean, not many public sector, even private sector banks have been able to report a deposit growth that is better than the advances growth.
Thank you, Lata, for the great compliment. Of course, the bank has been doing well in the last few quarters with regard to deposit growth, of course. And we had given a guidance to the market that our deposit growth will be to the tune of 8 to 10%. But then we have outgrown whatever we have given guidance to ourselves. But it will be a little moderated because of the base effect. The growth was, so sharp at 13.63%. But it will be moderated, and we are hoping to keep the deposit growth by 8 to 10% in the coming quarters.
But obviously, CASA has gone down for everybody. It's also a bit seasonal, I understand. There's a quarter-on-quarter fall in CASA, in the current and savings account as well. Do you see your cost of deposits going up? How did it do in this quarter compared to the previous? And what are you expecting in the coming quarters in terms of cost of money?
Yeah. If you look at the composition of deposit for the bank, it is, 73% is CASA plus retail, and the bulk deposit is at 27%. And as of now, our LCR is close to 161%, and so we are comfortably placed with regard to liquidity. Going forward, we will be seeing a little bit of increase in the cost of deposits. In the last quarter, we saw a little growth in the spike in the rate of interest in the bulk deposits. But I'm hoping not to bring in more of bulk deposits, rather than, look at increasing the low-cost deposits, especially the CASA growth is what I'm looking at. We are taking a lot of strategies and measures to see that the CASA growth happens in the bank, and we will keep it at low-cost deposits will be the prime growth center for the bank.
Okay. Well, the negative in your result really is the bad loans. I mean, it has come down, but even now at 7.5 or 7.34, the gross NPAs would rank among the highest in the industry. Is there any concerted effort to bring it? The banking sector is going through its best phase ever. 7 is a tall number for such a period.
True, Lata. We started the year, if you know, last year in March 22, we were at 11.11. That was my gross NPA, and we have brought it down to 7.34 now. The concern remains on NPA. The market is, almost 5.5. That's what the market is. But we have given a guidance that we will be around 6 and below 6 for the current year. A lot of efforts are, taking place in the bank to see that we reduce NPA. We have bought out, particularly verticals. We have got OSDL, that is a OTS. We are going very aggressively on OTS and the other forms of recovery also. If you look at return of accounts, recovery in return of accounts has been a major contributor for the current quarter also. And we will be considerably taking major steps to bring down the gross NPA numbers to 6 and below 6 actually.
Any expectations of recoveries, ma'am? I guess you all would have given the NARCL also some assets. You're seeing any recovery?
We have given close to about 10,000 crores is what we have given to NARCL. We have identified those accounts. And we have got last year, we have already given two accounts. We had already got some inflows. So we are seeing, we are constantly in touch with NARCL, and we hope to see some good improvements in the numbers even this quarter. And likelihood of 8 accounts are in advanced stages of discussion, and we hope to see some good offtake from the NARCL numbers also.
Okay. The other point I wanted to ask you is about OPEX. OPEX is up 12%. Now, do you see any scope to reduce it? Primarily, have you all been able to rationalize branches? I remember speaking to Bank of Baroda, and they have brought down their branches. I mean, I cannot remember the exact number, but about 5% reduction in branches over the last 2 years, because they had, common branches with the banks they took over. Could you make any such rationalization? Are you seeing improvement in costs?
The operating expenses, if you take into account in the bank, it is mainly because of the salary revision that we have made provisions and the pension provision. That's the only hike that we have seen. That's the reason the operating expenses looks a little higher at 12.38. With regard to your next question on rationalizing of branches, of course, the bank has done a lot of rationalization. We had close to 9,200 branches when the amalgamation started. We are at 8,400 branches. We will be reducing further. In the sense, I can tell you that we will not be reducing the number of branches, but creating, specialized branches out of the branches that we already have. And moreover, we are having also rural branches. We will be going in for more of BC-centric branches there, or instead of the brick and mortar branches, we will be looking to go growing in the fixed point BCs. That's the way we will like to go to branches expansion. We are seeing growth in certain pockets. If you look at my branch network right now, 59% of my branches are in the RUSU areas and 41% of the branches are in the metro centers. So RUSU are the branches where, we'll really look at growth centers for the current quarter also. And I'm well equipped on those locations. And with a BC network of almost 17,000 BC network, I hope to grow in those locations also.
Okay. So cost to income ratio that's fallen, which is, a very big positive, 43.66% at this point, a big fall from year ago levels. You see there is more scope?
No, I don't see much scope in reducing the cost to income ratio. The cost to income ratio was bloated a little in Q4 of last year, and because of one-time provisioning that we made on family pension. So going forward, we will be looking at the cost to income ratio to the extent of 44, or to the tune of 44 or 45. That's the one that I'm looking at. But we are taking a lot of measures to reduce the cost to income ratios. As I told you also, that we will expanding in the RUSU areas with fixed point BCs, and there are so many other measures the bank is taking to see that the cost to income is kept to a level of 44 or 45.
Okay, I'm assuming by RUSU you mean rural and semi-urban. It's not an abbreviation which all of us viewers understand. But let me come to, what is your SMA1, the loans that are 30 days past due and 60 days past due? How is it trending? And therefore, what's the year-end NPA likely to be?
My stress portfolio is to the extent of about 0.51% as of now. And we are taking a lot of measures to see that my SMA position or the stress book does not slip into the NPA position. In the MSME sector and the, you can say that the retail loan, there has been a little bit of stress. But then, the kind of approach that the bank is having with regard to maintaining the stress assets, it is quite comfortably placed. And even in the quarter, the slippages in MSME book was to the tune of about 700 crores and retail to the question of about 500 crores. But I'm hoping that this will be, at least to the extent of retail loans, I'm sure that we will be able to make good recovery, because this is totally mortgage based. So we will be able to have a recovery. MSME is about 766 crores is what we have slipped in the last quarter, and there also we will be having considerable recovery. We are using a lot of efforts, like we have regional collection center and the zonal collection centers. We also have a subsidiary called the UBI subsidiary, who also help us in recovery and maintaining the stress of the bank.
Okay. Two quick numbers. Therefore, do you still expect a further fall in your credit cost? Because you're saying that your stress book is under control. And secondly, is this NIM your best? You have a net interest margin of 3.13. Does it go back to 3 or does it go to 3.2?
It will be at around 3 is what I'm hoping. It will not, 3.13 was a good number, but we will be maintaining at 3. And as regards the stress portfolio of the bank, we would, last year, if you look at, every quarter, the slippages was to the tune of 2,500. Only in this quarter, I have seen a stress of about 2,500 crores. And because here there was an issue, because the two of the corporate books had fallen. And so the RAM sector is doing well. And I would like to keep my stress book to about 2,000 to 2,500 crores every quarter.
Okay. Finally, loan growth. What were you expecting, and from where will the growth come?
Loan growth, see, the GDP is growing at, estimated GDP growth is about 6 to 6.5%. So accordingly, we have also, seeing a growth of about 8 to 10% in the loan book. And the RAM is supposed to be growing good on all growth we are seeing in the RAM sector. And especially if you look at my RAM sector, I have seen good growth in the education loan sector, which is almost like 33% growth. Gold has grown by almost 53 to 54%. And in the large corporate, I am seeing growth in infrastructure, steel, pharma. These are the sectors that I am seeing real credit growth.
Okay. I would assume by RAM you mean retail and MSME. Again, we are weak on abbreviations. Thank you very much, Mrs. Manimeghalai, for joining us with your analysis of the current quarter gone by and the outlook. We are winding down on Bazaar on the note that the Sensex and the Nifty are sulking, threatening to even go below the 19,800 mark, but it will be only for perhaps a few hours. 20,000 can't be that elusive. Wrap up on Bazaar on that note. Short busters up next.